Welcome to Beat the Markets.
I'm Ritker.
And I'm VKM. So Ritker, one of the questions I get a lot these days are, can you help us figure out what we should do with our 401k? Well, can we?
Sure. We don't get paid for it, but we're always happy to help people set their allocations, choose the right funds within a 401k.
So I have a way I've been helping my friends figure out how they should put their 401k allocations. Right. Do you want to? How do you want to jump into it? Do you want to? Well, first things first. Let's start with how much money somebody should put into their 401k.
Oh, that's a good question. Yeah. So I've worked with a number of clients who have an account with us with an IRA or with after-tax money, but they may have a 401k with their employer. Now, 401ks are a pain in the butt. They're kind of an antiquated structure. They treat investors poorly. They give you a small number of choices. I think it's always mutual funds. I've never seen ETFs within a 401k of you.
Never.
Always mutual funds, and it's a certain list. It may be half a dozen, it may be 50, but you've got to pick from that list. You're lucky if you've got some Vanguard funds in there, or Fidelity funds, or index funds in general, because many of them are, well, they're going to be actively managed and not quantitatively managed, but kind of by the whim of the management. The management may not have any money in them, or a token amount if they do, no skin in the game. And the funds may be high fees. So, all right, so what do I look for if somebody comes to me with a 401k, gives me a list of funds and says, Ritker, what do I do? Well, the first thing I do is I look at what asset classes are available. There's usually something that approximates the S&P 500, if not explicitly an S&P 500 fund, but I'll look for a U.S. index fund, equity index fund. I'll look for a foreign equity index fund, and I'll look for bond funds. Really the most you can hope for is to have a low-fee stock index fund or two and a low-fee bond fund. You can't really expect to see commodity funds or REITs within an IRA. So I break it down by asset class first. I'll look for index as opposed to actively managed, and then I'll look at fees. And you really shouldn't be paying. Vanguard won't charge you more than 10 basis points, 5 basis points for this kind of thing. Just make sure you're not paying a percentage, a full percent or something for what's basically an S&P 500 fund, or something that's going to perform more or less like the S&P. And then you've got to choose an allocation model, a strategy. And within a 401k, it has to be something that you don't check very often, that you don't adjust very often. That's better, just like as a general rule for any account if you're managing it yourself. But from where we sit as advisors who don't actually control these accounts, we don't see them every day, we don't have access to them. We just, a client can check in with us once a year on their birthday, at New Year's, whatever, and say, here's what I've got in the 401k now. What do you think the right allocation should be? So whatever model you use has to be something that's very slow, a slow quant model. Now it's got to be quant. I mean, I'm just such a firm believer that you can't really wing it. You shouldn't try to wing it. Choose a model that works, it's proven to work, and then you don't have to think about it. You just do what it says. And in a once-a-year model, it's hard to use momentum. Momentum, you really have to check every month. You could say every 2 months, but in momentum, you're looking at performance over the prior 3 to 12 months, and you're using a filter of a long-term moving average, say 10 months, and you check it at the end of every month. If it's beneath that moving average, you're in. If it's above that moving average, you're in. If it's below that moving average, you're out. So you got to check it every month if you're using momentum. So if you're using value, you can only choose between momentum, value, and static.
Right.
Now static would be like John Bogle's 100 minus your age is the amount you put in stocks. That's
Even
fine.
that's not completely static because theoretically it's changing every year.
Sure, but
Right.
you adjusted it. You just adjust it once a year, or
Static enough.
static enough. So that's the very simplest thing you could do. But I mean, you know me. I like to look for an edge. Do what I can to reduce downside volatility without giving up too much upside. I'm looking for a good risk-adjusted long-term return. And I think that, again, people take way too much risk. They accept way too much downside. They set themselves up for long periods of underperformance with big drawdowns that they don't have to. And a very simple way to do that is to just use valuation when it comes to the stock component of that portfolio. So you could do something like the Shiller allocation model, or I like the Ritger allocator, which takes into account both your age and the valuation of the market. But you check your model once a year, and you say, all right, if stocks are cheap, meaning let's say the profit margin adjusted Shiller PE is beneath 12 times earnings, then I'm going to be at my maximum allocation in stocks and my minimum allocation in bonds. If it's in the mid-range, I'm going to be in the mid-range. If that multiple of choice is high and stocks are expensive, that means they have a low expected return over the coming decade and are subject to greater drawdowns and a higher likelihood of a big drawdown, then I'm going to set a minimum allocation to stocks. And at a time like today, when such valuation multiples are stretched to the extreme upside, I would suggest that you consider no stocks at all. I have suggested this to clients for their 401ks recently, because it doesn't matter what metric you're looking at, price to sales, market cap to GDP, cyclically adjusted profit margins, doesn't matter. They'll all tell you that we have a stock market that is as expensive as the year 2000 or 2009. So, you know how things, not 2009, 1929.
Okay.
No, 2007 was not terribly expensive.
Right.
Valuations retreated a bit from 2000. They hit the bottom in 03, and then stocks didn't even double from 03 to 07. It was a pretty lame bear market, and it was not that expensive. I think it was like 24 or 25 on the Shiller PE, off of lower profit margins. So if you adjust it, it was. But anyway, it wasn't that expensive in 07, but it just shows you. I mean, the market fell 55%, like on a daily closing basis, peak to trough, from a market that was not nearly as expensive as it had been in 2000 or in 1929. So today, to reiterate, we have a market that's as expensive as 1929 and 2000. And so it doesn't mean that this bubble can't go higher. It doesn't mean it has to crash this fall. It just means that there is a lot of downside from here, and that the long-term return is your expected return statistically. You're looking at how stock markets, the U.S. stock market or stock markets around the world, have performed from multiples like this over the past 150 years, you'll see that your expected return, your average outcome from a valuation like this is negative out to about 7, 8, 9 years. You get back to 0 around 10 years, and you're slightly positive. You can expect like a 2% return if you hold on for 12 years. And it doesn't mean the market just stays flat. That never happens. The market's always moving somehow. Sometimes it chops around at this high level for a while and then falls down, but it always comes down. You've got to expect a big drawdown. The market could fall by 60% from here and be at a historically average valuation. So anyway, to get back to 401ks, that's what I do. I would look for the lowest cost bond fund to make sure it's not a junk bond fund. Just a mixed corporate bond and treasury bond fund would be great. If you can diversify a bit more, if you have a foreign bond fund, you probably don't, but if you did, I'd probably throw a little in there. And just check it. So if a year from now the market has fallen 30%, then I would take a bit out of that bond fund and put it in a cheap stock fund. If 2 years from now the market's down by half, well then you're going to be at historically median valuations. Then if you're fairly young, middle-aged, you can put a nice chunk, I don't know, 50, 60, 70% or more in your stock fund, and expect a nice long-term return. I mean, stocks, you want to be in stocks. Like, I wish I could tell people just be in stocks. Stocks for the long run. Stocks are great. The problem is you have these secular bear markets that take you down by half and keep you in the hole for years. So that's the way to address that problem in a 401k, slowly and using valuation. And that means, yeah, I would have taken you out of stocks a year ago, and your stock funds would have gone up 15% or something since then, right? More. But that's the price you pay for not experiencing big drawdowns and having a more predictable account value. You don't ever want to see that account fall by half. You really don't need to. You think you're being more aggressive, you can have a better long-term return. It's just not the case. A higher allocation to stocks only really means a higher long-term return if you're talking 30 years or more. And there have been, people say there's never been a 30-year period where stocks have not outperformed bonds. That's not true. There was one in the 1800s, and it's come pretty close at other times. And why would you want to risk being in the hole? If you want a bigger retirement fund, you want more money when you're 65, well, I mean, save a little more.
Brutal advice. So the way I look at it, in terms of some models of approaching the 401k, one thing is that I don't love the 401k framework because of what you articulated. It's limiting.
Yeah.
There's only a fixed number of things that you can invest in, and it's determined by your the custodian or whoever's in charge of the 401k, and they have some incentives for putting in certain funds and not. But I think they are being because of these rule changes, I think they're being pressured to putting in some of these low cost options. So that's a good thing. The other thing, though, to keep in mind is so much of America does have their money in their 401k. So something to take seriously in terms of for the average person. Most people, that's where the lion's share of their investable assets are, outside of their home. So it's something that's important. It's something that's restrictive. So what's the right amount to put in? Rule of thumb I like to say is put in the amount that your employer matches.
Yeah, that's what I tell people too.
Because that's an automatic double.
It's free money.
It's free money. You might as well do that. If so, the employer doesn't match, then should the person put in nothing?
They can set up an IRA too, so you can max out an IRA.
Well,
and
can you open up an IRA if your employer?
You can open up an IRA on your own. It's just yours if you have a 401k.
Okay.
Off the top of my head, I don't want to recite the contribution limits.
I think it's like roughly around
6,500 for an IRA, unless has it been bumped up to? It was 5,500 and 6,500 for people over age 55.
It's something in that neighborhood.
We're portfolio managers. We're not like your typical investment advisors who know all this stuff. This is all they do. Like here's what you should be doing with your 401k and your IRA. Like I have to Google this stuff every time I do it.
But it's there. It's in Google.
But yeah, you can find it out. So yeah, I would consider having both an IRA and a 401k. But yeah, your matching.
So that's yeah. If you want to put more money in your retirement accounts, you can seek an alternative, but match what your employer gives you.
Yeah.
So that's free, like you say, free money.
Mm-hmm.
So once you have that, now you have to figure out what to do with it. The way I approach it is, what I do is I go through the list and just see what's investment worthy.
Right.
And that's driven primarily by strategies and fees.
Mm-hmm.
So if they offer something like a Vanguard fund or Fidelity or some low cost exposure, then I list it as investment worthy.
Yeah.
Then I group them. So the large groupings will be group it by assets. So the large groupings will be stocks, bonds, real estate. Usually you don't get real estate, but sometimes you do, and sometimes you get precious metals. And I'll have the groupings, and then I divide it into depending on how it lays out. So let's just say if you get stocks and bonds or whatever, you get your list, and then I like to do what we call 1 over n, and just divide it equally amongst the.
That's right. You like 1 over n.
Well, it makes it simple. So let's just say you have stocks, bonds, real estate, precious metals. Then you have 1/4 in each.
Sure.
If you want to be more aggressive towards.
But you're talking 1/4 in each asset class.
1/4 in each asset class.
Because you might have 5 stock funds and 1 REIT fund.
Exactly. Well, that's one of the things you'd have to tweak with given your investor preference. So you could. So this just happened this morning is that so we'll just start. The person it was all Vanguard. I went through the list and it was all Vanguard funds. And what was investable was 4, and they only had stocks and bonds. So four stock funds. It was a Vanguard S&P 500. It was a Vanguard mid cap. It was a Vanguard small cap, and it was a Vanguard developed markets. And then there was a Vanguard intermediate bond fund. So I group it, and I have four stock funds in the stock component, 1 in the intermediate bond fund, and then I keep an allocation for cash. In this particular case, right? The cash component is driven by investor preference and market conditions and valuation. So the framework would be that I have 1/3, 1/3, 1/3. So 8% would go into the 8.25% would go in the 4 stock funds. A third would go in the bond fund, and that third in cash can be allocated based on market valuation.
Okay.
So did we follow that?
Sure. So if you have a better yield on offer in the bond fund or lower multiples in the stock markets, then you'll shift some of that cash into one or the other.
Right, and ideally you don't want to be in cash, but it's driven partly driven by the markets.
Yeah.
And I would say, just so happens that this particular person has been accumulating these assets for the last 6-7 years, and they've been just accumulating it in cash. And now the person decided that, I really ought to do something really ought to invest.
So how do you? I mean, it's one thing to be in stocks if you've enjoyed all the upside in recent years, but to start to wade in you've got a big chunk of cash, and now you're going to wade in.
So that's
this time.
That's the dilemma. So in this particular in this particular case, I articulate the framework, but I said let's articulate the framework, meaning you choose your
You're gonna dollar cost the average in over say the next 5 years, 3 years.
Well, that's the next. Yeah, that's the next thing we talk about. I would like to discuss, which we'll get into. I want to wrap up this point, and we'll get into it. But the point I do want to get into is that for the younger investor, meaning you're not so close to retirement, do valuations and the time you start really matter if you're continually going to be adding and dollar cost averaging over time. But let's table the answer.
Matters less.
It matters less.
Okay.
But before we get into that aspect, which was the first question, or the prior question, which was that the person is really, for all intents and purposes, just starting with the market. They have a pocket, a bag full of money bag full of money, and they haven't enjoyed the gains of the markets, and we have the market valuations that we're at present.
It's a funny thing when the markets are up, the people who have been waiting decide, oh, it's finally safe to get back in, which is exactly when it's most dangerous.
So, some of it is definitely that. Some of it is partly driven by where my peer group is in their age. I'm 42, and I think they say life begins at 40, and my theory on where life begins at 40 is you spend your 20s kind of dabbling around, figuring out where you want to take your life, and if you're lucky. If in your 30s you kind of put together some of the pieces of the puzzle and put it together, and by the time you get into your latter 30s and 40s, you've accumulated maybe some assets, and now they're at the age where they have to start thinking about what to do with it. I think part of it is certainly if the markets were horrible and they wouldn't even consider it, but I think it's a combination of where people feel about the markets, It's in the news evaluation, and partly where these particular people are.
So I would say you want to make sure that you don't have a bad time right off the bat.
I think that's a huge important thing for the psyche.
Yeah.
We can go this long different way, but this is super important for the psyche to believe that this process works, and not to have that bad start, so you keep with that process. This was, one of the things that we thought about discussing, the idea of long-term investing, and one of the my fears with 401k plans, is that people bucket it into long-term investing, and then long-term investing just means not really thinking about it.
Right.
And that's my fear in that. But what I do believe is identifying a process and sticking with that long term.
Yeah.
So back to this particular situation, I articulated the framework, which is let's list the funds that we're interested in and just do 1 over n, or you can do 1 over n, meaning you could literally you get the right allocation in a framework, because usually you have 3 or 4 stock funds, you have 2 bond funds, and you have 1 or 2 of the alternative real estate or gold or precious metals, and you do 1 over n. It kind of buckets out to the right percentages. Or you could be bucket into the asset class, stocks, bonds, and do 1 over n, and then divide it up that way. But that's the framework. That's the articulated framework. The next thing is, when do you pull the trigger and do it? And that's the thing. I said let's table that for right now, because you've accumulated assets for 8-9 years. You haven't enjoyed the gains. We're going into historically, May to, for whatever reason, May to November is generally not a great time.
September is statistically the worst month.
September statistically the worst month.
I don't put a lot of stock in this. I mean, the differences are fairly slight, but September is a...
Yeah, so you've waited 8 years, 9 years. Let's just wait at least a couple more months.
Yeah.
But that's in this particular case. And to answer that question is, how do you answer that question of what should a person that's newly approaching their 401k?
Yeah, you want to wade in slowly. It's not like there are screaming bargains available right now. It might be a different story if this were 1974 or 1982 and you had a Schiller PE of 8 or something. Like, a market that was unambiguously cheap and a screaming opportunity to lock in a really nice expected long-term return. But we don't have that. We have the opposite. And so I would just take a very cautious approach.
So let's talk about that, because how will you define waiting in slowly?
Valuations take years to correct. Crashes happen faster than bull markets. The average length of a bear market, if you say a bear market is a decline of 20% or more, is 18 months. It's pretty quick. This bull market has been eight and a half years. The last crash was October 07 to March 09, so less than 18 months. Valuations can correct quickly. It usually happens slowly at first and then very quickly in the middle, and the end slowly again. But it can happen. Like in 1987, valuations corrected 22% in a day, and that was it. They didn't really fall any further after that. They weren't terribly high to begin with, though, in '87. When you're coming down from a valuation like this, it's more like the year 2000. It was, I think the internal peak was January 2000, NASDAQ peaked in March, and the bottom wasn't until early '03. I think NASDAQ bottomed in the second half of '07. Second half of '02.
That's right.
So you're looking at, it could easily take 2-3 years. Could take longer. Think back to the 19-teens. We kind of chopped around at high valuations. We got up to be, we were very expensive by hell before the crash of 1907. But then we rebounded quickly back to high valuations, and companies kind of earned themselves into those valuations for 10 years, and then still at the end there was a washout after the First World War ended. We had a short, deep global depression. It didn't end until like 1921. By which time you had really cheap valuations again. So it can take a long time. 1966 valuations were pretty high. You didn't get real value until '74, and things stayed cheap until the '80s. So if you're using valuations to time the market, you've got to be patient. You've got to be real slow and deliberate about it. Momentum, again, momentum looks at trends over the last several months, and it's in for a month, and it sees how it goes. It gets in, it says, all right, well, we'll stay in for a month, and we'll see how it goes. And then a month later, how's it going? Are we in or out? How's it going? Are we in or out? It's we like it because it's something that works regardless of valuation. So you can enjoy the upside of a bull market well past the point at which a prudent value investor would have gotten out. Like our strategy is up nicely this year.
It's having a good year.
It's up nicely, knock on wood. Despite the market being terribly overvalued at the beginning of the year. So if we were doing value, we wouldn't have been in the market at all, and we'd just be sitting in bonds, clipping coupons. So I would say years. If you're going to wade into a market that's very, very overvalued, make a plan that gets you in either by valuation.
I think you have to.
Or over years, like several years.
So I had a friend who came into a windfall of money, and went from work. He was, he worked hard for. He's 40-something years old. He had something happened at work, and he got a windfall of money, and it was the first time he really had a chance to have a corpus to invest in, and he thought he was going to do the right thing and do low cost, low fee investing, and he was going to do it, wade into the market slowly, and he defined slowly as 6 months.
Oh no!
So he spent, so he's, every month I guess made his allocation. So that's the first thing is, I would say, the answer to that question is it's going to take what it's going to take
take a look at a 100-year or 140-year chart of the U.S. stock market. You'll never see it on Bloomberg.com or in the Wall Street Journal, but you've got to be aware of what the market has done in the past, because that tells you what it can do, what it's capable of doing. And when you look at a chart like that, I'll post one on Facebook, or put a link on YouTube with this video. When you look at a chart like that, it dispels any illusions about what kind of time frame you're working with.
So to bring it up to this particular earlier situation I was talking about, my friend who, this morning I was working with. So that's, so if you take everything into account, this is the way I look at it, is that if the person has 1/3 in stocks, and it's diversified stocks, right? It's S&P 500, it's mid cap, U.S. mid cap, U.S. small cap. So you could say maybe they're going to be correlated, and then it's developed markets. So that's going to be partly correlated and partly uncorrelated, and then 1/3 in intermediate bonds, and then 1/3 in cash, and then their earning years are still ahead of them. They're going to have, if they did something like that, where they have 1/3 in stocks. And the value being 1/3 in stocks is because, for the psychological reason of being in stocks, is that if stocks keep going up, they're like, okay, well, at least I have something in it. Just as it won't, meaning you want to have a good start, and one of the ways to have a good start is and keep with the process is to not put everything all into stocks and get off to a bad start, but also to keep with your process. You don't want to do things that are reactive, that cause an extreme reaction.
Right, you've got to have a plan. You can use 1/n. You can use 1/n. You can say, all right, at every point going forward, I'm going to have 25% in stocks, 25%, let's say U.S. stocks, 25 in foreign stocks, and 50% in treasury bonds. That's my plan. Or you could do, the permanent portfolio, 1/4 in the U.S. stocks, 1/4 in long-term bonds, 1/4 in treasury bills, and 1/4 in gold. That's my portfolio. Sticking to it till I die. I actually like that one.
Yeah, I like that one too.
Because its worst year ever was down 4% in 2008. Its return is like high 8%, meaning it doubles. It doubles every 9 years or something.
And it's stable.
It's stable. It's the stock market's long-term return is like 9 something percent. And it gets into big trouble, whereas a true diversified portfolio, it's as simple as always 25% in each. You rebalance every year. It never gets you in big trouble.
It's an easy process, and you can stick with it.
Yeah, and you kind of know, like, all right, in the year 2025, my kid's going to enter college. How much money am I going to have there? If it's all in stocks, maybe that's a bear market year, and you have half as much as you expect to have. Whereas with a good asset allocation, you have a lot more predictability. So yeah, I'm okay with 1/n, but I just would be careful. I would be careful to make sure that you can live with the kinds of drawdowns that come from that static allocation.
Right.
If you're
you get the benefit of dollar cost averaging.
Yeah. That if you're dollar cost averaging it, then fine. Yeah.
And the way to make it unstatic, I would say, is or dynamic, is to you have the 1/3 in stocks that's fixed, 1/3 in bonds that's fixed, and that 1/3 that's in cash is driven by
valuation. Now you gotta know how, you gotta have objective signals.
Yes.
On how to allocate that cash.
Right. So let's pick one. The Richter allocator, we could get into, you could use the Richter allocator, or you could do the Schiller PE, is in or out. If it's below, 22, it's in, above 22, it's out, or pick.
Well, I got different brackets. Like you're most aggressive when it's cheap, you're at your default when it's in the middle, and you're least aggressive when it's expensive. So, and you've got to have clear, you pick your indicator and pick your levels, your numbers. It's got to be unambiguous.
That's right. Absolutely.
And you got to be clear about your dates.
What do you mean? Oh, which day you're going to measure on?
Well, yeah.
Now, in reality,
what's helpful about using valuation as opposed to just what you can act fast if you have valuation, if you want to. If you want to be more attentive, check your portfolio more often. Again, we're not getting paid to do this, so if somebody wants us to look at it every month, probably not gonna agree to that. But if we have a big crash and like a big spike down, and stocks all of a sudden get really cheap, I might send an email saying, hey, you want to take a look at your 401k right now? Maybe it's a good time because things have changed. So that's one advantage of using those objective valuation signals, because then they can be crossed at any time. And like we saw in '09, the market, it got to a reasonable valuation, but it didn't stay there for long. I mean, it shot out of there.
Right. I mean, March '09, and then by
that spring, it just rocketed out of the lows. So if you happen to take a look at that portfolio in February, March, then you would have adjusted and gotten in at a pretty good valuation.
Right, but if your annual check was January 1st, then you might
have picked up the January 1st. I mean, the market was still down like 40% or whatever from a year before.
So it still would have been a yes.
You still would have adjusted into it.
Right, right.
So I mean, it's not always that fast. The market doesn't always recover that fast. Sometimes it languishes a long time. The Great Depression and the late 70s or early 80s, you had time.
And I mean, in the big scheme of things, if you're talking about investing over a long time frame, missing even a month or a year, being a year late or a month late, it's not going to be the end-all be-all of things.
Yeah. So what else can we say about 401ks?
Well, this is another thing. We talked about someone that's coming into sort of having to make that decision now, or we didn't talk about a younger person who's in their 20s who's starting, which is probably pretty simple, which is just start the process. I'd say they don't have a tremendous amount of accumulated capital. But what about somebody that's a little later in their 401k, which is where the bulk of the 401k money in America is? Let's say somebody who's in their 60s and close to approaching retirement. Let's talk about that. What should somebody who's, say, 60 years old, they're going to be retiring what is the retirement age? 65?
65.
So let's say they're retiring in the next few years. They're 60 years old, 58, 59, 60. They've been all in stocks for their entire career. They've enjoyed tremendous gains in the last 20, 30 years of working and employer matching. They have a nice corpus in their 401k. They're 100% stocks. What should that person do today?
If they're 100% stocks, then that's just been their plan. It's kind of the default in America.
Well, should you adjust now that they're age and they're retiring?
Yeah, of course. It's.
Or let's not do that. Let's not take to that extreme. Let's say they're 60-40. Let's say they followed some balanced plan.
They're older, and regardless of valuation, let's say you just don't believe that it's possible to handicap the odds of a bear market. I would argue with you, until I'm blue in the face. But if you don't believe me, well then I would say to you, well, do you believe that bear markets have happened, or that bear markets are possible? Can it happen again? Twice in the last 100 years, the stock market has gone down by over 70%, 75% in one case, 66 to 82 when adjusted for inflation, and 85% in the Great Depression, and 50% a number of other times. So yeah, bear markets happen. Can you take a bear market at your age? What happens to that portfolio? And you don't want to take that risk. That's the answer. The older you are, the more it's going to hurt you, because you're going to start taking money out of that portfolio within the next few years, and you don't want to have to take money out when it's down, because then you're taking you are to support. Let's say you need to withdraw $5,000 a month from a 401k along with whatever other money you have. And if let's make it easy. Let's say you have $1 million portfolio and you're going to take out 4% a month, $4,000 a month, right? That's about the upper limit of like what I'd say is prudent within a kind of generic portfolio. So okay, it's $1 million portfolio, and you're taking out 4% a month today. That's $4,000, and you plan your retirement on that $4,000 coming from the 401k plus Social Security, a pension, whatever else you have, rental houses, whatever. Now, that portfolio falls to $500,000. Now you're talking about withdrawing 8% a month. You model that out, and that portfolio is going to shrink a lot faster. It's not going to last as long as you need it to last at an 8% withdrawal rate as opposed to a 4%. So that's the risk you run. You run the risk of depleting that portfolio down to nothing before you die. So that's why the older you get, the more conservative you have to be. And that means more bonds. It means less risky bonds, meaning higher credit, lower credit risk, higher credit rating. So your blue chip corporate bonds and treasury bonds. You get very little beta, like extra return, for accepting risk in the bond market. Yeah. For accepting credit risk. So there's no reason to have junk bonds, and there's not a whole lot of difference between like blue chip corporate bonds and treasury bonds. So I would just say just use treasury bonds, just simplify it all. You know that they're going to pay. Like there's no default risk at all. You know they're going to pay. The only question is what the money's going to be worth after inflation. And what happens in interest rates if you're holding really long-term bonds. So the older you get, the closer you get to cash. So that means less stocks, less risky bonds, and less duration in your bond portfolio. Shorter term bonds. So let's say you have a 90-year-old lady, and she's got just enough money to make it until she's like 102, just in case. You don't want to take any risk with a portfolio like that. So you're going to put it in like 2 to 3 year treasury bills, something like that. And if there's no reason to take risk for a long-term return, because there is no long-term, but there's a big reason not to take risk. And so you just get closer and closer to cash.
So that's one of the things I think is an important point, which is that why take the risk? Yeah. Meaning, or look at what the upside versus the downside is in the absence of valuation.
Yeah.
So as you getting the person who's getting older and has this corpus, they should just circumstantially start de-risking.
Absolutely.
One of the things my dad had the realization, which is why he de-risked, was he's like, okay, the upside's not worth the downside. If I lose a significant chunk, my lifestyle's going to really change. If I gain much more, the only beneficiary is going to be the U.S. government or maybe me or his children. So he's going to the upside he's not really benefiting from, and the downside he's going to really eat it. He suffer. So he de-risked. But now he has his unique situation. One of the things I hear a lot about when you give the advice to de-risk is that, well, I'm either not getting a return, I'm only getting 1% or 2%, and inflation's killing me there.
There comes a point at which it's just too late. Like, you don't have enough earning years left, or you're not earning anymore. You haven't saved what you need to save. Don't try to make it up in the markets with a higher return. That's crazy. You can have a really bad time. Just find other sources of income if possible, do consulting work or just get frugal. Americans spend too much. It doesn't make you happy. It's not where happiness comes from. Just make the numbers work under a prudent investment plan that does not give you a chance of a really bad outcome. And the default investment plan that America's financial advisors are putting our baby boom generation into is not prudent, and they're going to have a very bad time.
It's brutal advice, but it's right advice. Is that if you don't have enough, don't expect it from them. Don't think the market's going to get, because the markets don't care about your situation, right? The markets are going to give you what they're priced to give you.
It's not brutal. This is America. Like, it's the land of plenty. Like, do you need a new car at your age? I mean, what is that going to do for you? Do you need to take that vacation? What's wrong with a cabin on the lake, like you took with your parents in the 1950s and 60s? You had a good time then. You can have a good time now.
And so that's advice for the older,
yeah.
the middle and the younger. Probably advice is learn about investing and get started, because time is your best friend.
Learn about investing, make a plan, stick to it.
That probably is about it.
Yeah, that's it. Just it's all about the plan. Understand what you're doing. Understand enough about the markets to know that you need a plan. Enough about yourself too. It's about discipline. It's about sticking to a plan.
Yeah, make a plan. It's know yourself so you can make a plan that you can stick with.
Yeah, exactly, and then do it. Just stick to it. It's not worth worrying about this. Let us worry about it. We get paid for it.
and then to wrap it up, but that's you can have a plan for all have a plan for your 401k, even though it's don't make the default this long-term investing and I'm
no like there might be like a plan manager that your employer has contracted to manage your 401k. Take a look at what's actually happening in it and know what's happening, and really take control of it yourself. It's got to be in a 401k. It's got to be simple, and if it's simple, you can understand it and do it yourself.
That's perfect. Let's leave it on that note.
All right. Thanks for tuning in. Don't forget to like and subscribe.
See you next time for episode 9.